I don't think you're going to hear very much, though. It's been laid out pretty clearly. The economy is growing very well. The Fed is continuing to raise interest rates. We expect to see another 1 to 2 rate increases this year as the Fed gets back to neutral. But you've got a very strong job market. You've got booming asset prices. You've got very good things in terms of investment spending here in the United States. Look at capital goods that just came out this morning. It's moving towards about a 10% growth rate on capital goods, so that you can think of that as investment. And it's accelerating very sharply here at the end. I won't say the end of a expansion, but deep into an expansion. It's kind of unusual. So a lot of good things happening. The Fed's going to have to address this.
Every so often, our market does seem to respond to the possibility of a deepening trade war with China. No real progress in these lower level meetings that took place over the last couple of days. Are you concerned?
Yeah, I think so, but it's a very sticky topic because it's really going to be winners and losers, and it becomes an exercise in microeconomics just as much as macroeconomics. So for us, we're really focusing on individual companies, trying to understand how they might be exposed one way or the other to trade or a slowdown in global trade. And it's certainly nothing that anybody wants to see, and very few countries would benefit from.
Chinese currency had a big move overnight, Kevin. We can always read into that. Never quite explained. It looks like they're going to fight back over what has been a stronger dollar and a weaker Chinese currency. But also, we have this impasse on trade talks with nothing further scheduled. Always hits their market, it feels, harder than ours. Can the global market rally in the face of China's markets weakening?
Well, the global market is less even this year. We're seeing things like Turkey, the devaluation in China. Remember, that's their tool. They don't have the same latitude that we do in terms of tariffs, but it's still a way of intervening in trade in similar ways, but they're just using a different tool to get there. So ultimately, an increase in global disintegration would be the biggest risk to what's been a very long-running bull market. But we're still not sure how much of this is really posturing and how much actually gets put in place for the long term, and how much of this is saber rattling. We really just don't know that yet.
Kevin, in terms of sort of the drivers of U.S. stocks, obviously this year we've seen this huge step up in the absolute level of corporate earnings. Tax cuts, you had that synchronized growth. There it is. This is around the time of the year where next year's earnings forecasts typically are going to start to erode a little bit, be just a normal kind of downgrade as we get closer to the coming year. That's not really happening right now. It seems like 2019 forecasts are holding up for the moment. So does that tell you that at least the support for stocks are there, or might we get blindsided by a stronger than expected slowdown in the first half of next year?
Well, if there's a problem with global trade and global growth fades away, then yeah, we'll have a problem. But to your point about earnings, the earnings forecast jumped right after the passage of the tax package, and that reflects the tax effect. But look at revenue growth. Revenue growth is up almost 10% for the S&P, and that's not about taxes. That's more of a growth story. So there is the things that we're seeing, the strength in the U.S. economy in particular, were things that very few, including ourselves, would have forecast 3 or 4 or 5 or 6 years ago. So it's truly an extraordinary thing, and those fundamental developments are still with us, and they have helped lift the stock market to where it is today.